Is Emily Wills, and I at the Hain Celestial Group. Hain Celestial is an American food company whose focus is natural foods and personal care products. The nature of their business is centered around offering a wide variety of products that are for health-conscious and environmentally aware consumers. Hain Celestial Group falls into business environments of industry competition and threat of substitution. Since it produces natural foods and personal care products, very competitive industries, they must invest in advertising, research and development, and more to stay competitive. They must compete with other companies to retain customer loyalty. If there are readily available alternatives to their products, like a lower cost option, Hain Celestial Group faces a threat of substitution. This can limit the company's ability to raise prices if consumers choose to purchase another similar product. From Hain Celestial's annual 10-K reporting ending in June 2023, the company's current assets have slightly decreased, while non-current assets have decreased significantly. Liabilities and stockholders' equity also decreased. The decreases in current assets suggest changes in liquidity or inventory management. Reductions in liabilities indicate debt reduction or improved capital management, and a decrease in retained earnings resulted from losses or increased dividend payout. So it's just the common balance sheet. That's all of the percentages. So cash and cash equivalents decreased from 2.66% in 2022 to 2.336% in 2023. This means there was a slight reduction in Hain Celestial's cash position in total assets. This could be operational spending, investments, or other financial activities. Accounts receivables increased from 6.94% in 2022 to 7.13% in 2023. Inventories increased in 2023. Prepaid expenses increased. Assets held for sale only had a slight decrease of 0.01%. Goodwill increased from 37.98% to 41.56%. Trademarks and other tangible assets relative to total assets decreased from 19.42% to 13.2%. Current liabilities increased. Additional paid-in capital decreased. Retained earnings decreased from 31.28% to 28.89%. And notable changes include increases in accounts receivable, inventories, percentage of total assets, as well as a substantial decrease in trademarks and assets. Changes in stockholders' equity, like additional paid-in capital and earnings, indicate potential shifts in the company's financing and dividends. The number of shares authorized is 150,000. The shares currently outstanding at 89,475 in 2023 and 89,302 in 2022. This indicates that the company has a substantial number of authorized but unissued shares available for potential use. The company did not pay dividends. The company's financial activities involve financing, including borrowing, share repurchases, and addressing changes in equity accounts. Multiple non-cash items impacted retained earnings indirectly affected by net income, like depreciation, deferred taxes, stock-based compensation, and asset impairments. Hain Celestial Group has accumulated earnings and losses. The changes in retained earnings are seen from year to year, including net income and net losses. There are also years where the company experiences net losses. Common stock increased slightly. Additional paid-in capital increased, suggesting that the company issued more shares or received additional payments from shareholders during the year. Retained earnings decreased slightly and can be caused by the net loss the company incurred during the year. The proportion of short-term and long-term investments are 24.41% in 2022, 26.17% in 2023. The increase in 2023 suggests that the company shifted its resources toward more liquid assets to maintain flexibility in response to changes in the business environment. Having a reasonable proportion of short-term assets in their business environment is important because it allowed the group to manage working capital efficiently, respond to market fluctuations, and navigate the competitive landscape effectively. The largest assets are goodwill, property, plant, and equipment, and trademarks, and other intangible assets. The largest liabilities are long-term debt, total current liabilities, operating lease liabilities, and deferred income taxes. Goodwill slightly increased in 2023. Property, plant, and equipment remain relatively stable, and trademarks and other intangible assets decreased significantly. Long-term debt decreased from 2022 to 2023, suggesting they may have paid down some of its long-term debt or refinanced at lower rates. Total current liabilities decreased from 2022 to 2023, indicating more efficient management of short-term obligations or changes in working capital requirements. Operating liabilities decreased, meaning the company may have renegotiated or paid down some of its non-current lease obligations. The equity ratio in 2023 is 45.07%. The proportion of assets financed by non-owners is 54.93%. This indicates that Hain Celestial Group relies on external sources of financing, including debt and other liabilities, to support its operations. The food industry can require substantial investments in facilities, production, equipment, and distribution. The food industry is also very competitive, so investments in marketing, research, and development is expensive. The Hain Celestial Group has a working capital of $360,164 for 2023. The company has sufficient short-term assets to cover its short-term obligations. The factors driving this measure are the composition of current assets and liabilities. Current assets, like cash, accounts receivable, inventories, and prepaid expenses, exceed current liabilities, being accounts payable, accrued expenses, and current debt. Positive working capital tells us the company can meet its short-term financial obligations comfortably. The ROA for 2021 was 2.94%, in 2022 it was 3.17%, and for 2023 it was negative 5.16%. The negative ROA shows a loss greater than the value of its total assets. The assets were not efficiently utilized to generate profits that year. In 2021 and 2022, the company had positive ROA, meaning it generated a positive return on assets. The ROA was the highest in 2022, indicating improved profitability or more efficient use of assets. Asset turnover for 2021 was 0.80. In 2022, it was 0.77, and 2023, it was 0.52. These indicate how much revenue Hain Celestial Group generated for every dollar of its average total assets in each year. Higher asset turnover ratio suggests better asset utilization efficiency. Asset turnover efficiency decreased from 2021 to 2023. Current ratio in 2022 was 2.23 and 2.56 in 2023. The quick ratio in 2022 was 1.08 and 1.22 in 2023. The increasing current and quick ratios from 22 to 23 indicate the company's ability to meet its short-term obligations and cover its current liabilities improved. A ratio above 1 indicates the company has more current assets than liabilities. There are no concerns about the company's ability to meet short-term or long-term debt obligations. Liabilities to equity ratio in 22 was 1.27 and 1.22. Hain Celestial Group falls into packaged foods and meats. The liability to equity ratio norm for that industry is about 1.4. Since Hain Celestial Group has a lower ratio, they could have a lower level of financial risk, and the company is not taking full advantage of leverage to boost returns. The market cap as of June 26, 2023 is $273,518.64 at $12.51 a share per Yahoo. The book value, or using the stockholders' equity, is 0.25. A market to book ratio of 0.25 suggests that the company's market capitalization is lower than its book value. The market could be undervaluing the company's assets and for future earnings potential. The stock price could be trading at a discount to the book value per share. There might be risk factors associated with Hain Celestial, or broader market concerns could be hindering. Total revenues or net sales are $1.7 million in 23, $1.9 million in 22, and around $2 million in 21. Cost of sales are $1.4 million in 23, $1.5 million in 22, $1.5 million in 21. Gross profits are seen there. SG&A is also seen there. The company reported a significant operating loss and a net loss primarily due to high impairment charges and increased interest expenses. The company appears to be declining as seen in the revenues, gross profits, and the increase in operating or loss income, expenses increasing, and common share decreasing. This is the common size income statement. They generate revenue through manufacturing and selling products to customers. The largest sources of revenue for the company are to come from its main product lines or business segments. The company reports the cost of sales in its financial statement. These costs are directly related to the production or delivery of the products or services that generate revenue. Interest is a significant expense for this company. Interest and other financing expenses in 23 was 2.55%, growing from 0.44% in 2021. The EBIT for 2021 was 12.47, 8.23 in 2022, and negative 2.83 in 2023. This means that there was a decline in profitability. The EPS is negative $1.30 per share in 23, when it was 84 cents in 22 and 77 cents in 21. The change from 2021 to 2022 was consistent, but from 2022 to 2023 was significant. The profit margin ratio and net income as a percentage of sales have increased from 2021 to 2022, then decreased in 2023. In 2022, Hain Celestial was more profitable compared to 2021 with higher profit margins. 2023 profitability decreased compared to 2022 with lower profit margins. Changes in profitability can be driven by various factors, like changes in operating expenses, cost of sales, or changes in revenue. The ROE for 2023 is negative 11.45%, while it was 7.19% in 2022. There's a substantial increase in intangibles and long-lived asset impairment compared to prior years. In 2023, the expense is $175,501, while it was only $1,903 in 22 and $57,920 in 2021. They also reported a net loss of $116,537, which was a significant change from 2022 and 2021. The diluted net income per share is also negative $1.30, which is a significant change from the positive values in previous years. There are more weaknesses than strengths for the Hain Celestial Group. In 2023, they have a net loss, impairment charges, negative earnings per share, interest expenses, and operating loss. Cash flows from operating activities are net cash in 2023 of $116,000, $77,000, and $77,000. Net loss in 2023 had a significant impact on cash from operating activities compared to the positive net income in the previous 2 years. Operating cash flows are larger than the net income. And then in 2022, operating cash flows were slightly larger than net income. Non-cash items and changes in working capital had a minimum impact on the difference between income and cash flow. Major differences between operating cash flows and net income result from non-cash items that affect net income but don't impact cash flows. Operating activities were a source of cash. In all 3 years, investing activities were a use of cash for the company. Financing activities were primarily a use of cash for the company in all 3 years. Current ratio of 2.22 in